Dinasti Equity Fund has performed extremely well in the first half of 2026. The fund outperformance was primarily driven by our positioning in structural growth team, which continued to deliver despite a relatively muted macro backdrop in China. And we maintain significant exposure to Taiwan AI supply chain, where demand for global AI infrastructures build-up remain exceptionally strong, benefiting semiconductor, networking, server, and relative technology company. Within China exposure, we focus on areas that benefit from the technology self-sufficiency, automation, and robotic, as well as selected industrial and advanced manufacturing names where earning momentum remain resilient. Our preference for A shares over offshore H share China equity also helps to contribute to the positive performance, as the onshore market proved to be more resilient to the geopolitical headlines and the global risk sentiment. In addition, our underweight exposure to weaker consumer sector and selective stock picking in China contributed positively to the relative return. And more broadly, we are closely monitoring whether capital market reforms, improving household assets allocation towards equity, and continued inflow from the institutional contribute to what we believe to be very positive for the China A shares market going forward. Yes, we remain cautiously optimistic that earning growth can broadly meet the market expectation the second half of 2026. Unlike the previous cycle where expectations were heavily reliant on the aggressive stimulus, and this time around the current earning recovery is increasingly driven by company fundamentals. Consensus expects MSCI China earning growth of approximately 14.3% in 2026 and 12.7% in 2027. And earning revision has continued to trend positively, supported by improving return on invested capital and a gradual recovery in profitabilities. While domestic consumption remains soft and the property sector continue to face challenges, export strength, AI-related demand, technology upgrades, and industrial upgrading, which are supporting earning across many sectors. As a result, we believe the earning recovery is becoming broader and more sustainable as compared to the previous cycle. For the remaining second half of this year, we continue to focus on the 5 key structural themes. Number 1, AI infrastructure and the broader semiconductor ecosystem, where both Taiwan and China remain beneficiary of the global AI investment. Number 2, the China semiconductor localization story, which remains a multi-year structural theme as China accelerates efforts to reduce reliance on foreign technology. Number 3, we continue to like the energy storage system and the battery technology, when China continues to hold global leadership position and to stand to benefit from data center power demand, electrification trend, and also renewable energy deployment. For theme number 4, we continue to focus on automation and robotics. We see as one of the most attractive beneficiary of China push toward industrialization, upgrading, labor productivity enhancement, as well as the emerging of physical AI. Last but not least, we will continue to invest in China healthcare and drug innovation for the long term, where Chinese companies are increasingly closing the gap with the global peers in research development capability and becoming globally more competitive right now.